All right, so in the last video, we were introduced to adjusting journal entries, the when, the where, the why, the how, and I gave you some guidelines to help you as we prepare those. So we are going to prepare them in this video. I'm going to give you some additional guidelines to help us. So let's do that on the next slide. All right, so in addition to adjusting journal entries, having to follow those same rules, I'm going to give you some extra guidelines that pertain only to adjusting journal entries. Okay. So these guidelines include, we're never going to see the cash accounts. So cash is never involved. Cash is involved in adjusting journal entries. You'll see why in a few slides. I will explain why that is. I can tell you now, but cash is usually, if it's in the case of a deferral, the cash has already happened. If it's in the case of adjustments that we call accruals, the cash is going to happen later. So we don't want to accidentally record cash twice. So that's why the adjusting entry, that is not going to hit the cash account. Okay. Another thing we're going to see is that the equipment or other depreciable assets are not involved in our adjusting entries. So no long-lived asset is going to be involved in adjusting journal entries. Okay. Mostly we're going to see equipment. That's why I wanted to highlight equipment. Okay. Some more guidelines. Okay, so an expense or revenue accounts is involved in each adjusting entry. Okay. Also, an asset or liability is involved. Let's say updated is updated in each adjusting entry. Okay, so these are some helpful tips because as you're preparing these entries, you might step back. Like, for example, maybe you do one and you're like, oh, cash and AR. And you're like, there, I did an adjusting entry. Well, if you use this guideline, these guidelines here, you'll say, oh, well, cash is not supposed to be an adjusting entry. So you may have done an original entry, but you did not do an adjusting entry. Plus, we also don't see an expense or revenue account. Here we see two balance sheet accounts, two asset accounts. So you're violating two of the guidelines, right? So you know nope, that's not an adjusting entry. Okay. All right, so let's go ahead and try some examples. All right, so here we have Misty and Brock. They started their corporation that focuses on the nutritional and spiritual needs of Pokemon, of course, so important. At the end of August, the following information is available. Now, right there, them saying the end of the period, that is already cluing me in that we are going to be making some adjusting entries because we said the when of adjusting entries. I like that I did air quotes for the when, but you couldn't see that. The when of adjusting entries was at the end of a period. Okay, let's see. 1/3 of their supply balance has been used. All right, so usage, if we've used something up, we have to put it to our expense account, right? That is what the expense recognition principle tells us. You remember those principles from chapter 3. It says that the company must record an expense. Record an expense when the benefit has been received. The benefit, say in the time period, the benefit is received. In the time period, the benefit is received. That's why the expense recognition principle is also sometimes called the matching principle, because it matches the expense to the period in which you get the benefit. Okay. All right, so right there, I see used, I'm thinking expense. Gotta put it to an expense account. All right, so the expense account is going to be supplies expense, which we really haven't used up until now, right? We've been dealing with supplies as an asset. We've been buying supplies. This was our original entry that we did back in chapter 3. We buy supplies and we have to say we pay it with cash, okay? And so then we have it sitting on our balance sheet as an asset. And some of you asked, like, why? Why is it? It's because we had not yet used it, not yet used up. But as soon as we do use it, gotta record the expense to be in compliance with the expense recognition principle. Okay, only record the amount that's been used. So 1/3 or $500 will move to expense. Okay, we know that for each journal entry, we have to follow our standard rules, which means we have to have a credit account here. So the account that you're going to credit is the asset. We want to bring down the asset. Why? Because you've used it up, right? You've used the asset. So you want to show that the value of that asset has gone down. You've moved it to supplies. And you can say to adjust for supplies used in the period. Used in the period. Okay, now let's go back and make sure that we've met those guidelines. Okay, there was no cash. You saw me journalize cash up here, but it was for the original entry, not the adjusting entry. These are your guidelines for adjusting entries. Right, for adjusting entries. So there was no cash account in my adjusting entry at August 31st. We weren't dealing with equipment, so that one's kind of NA. We need to have either an expense or revenue account involved. We did, we had supplies expense. And then there needs to be either an asset or a liability that's being updated. And that's true. We were updating the supplies account, updating it to the correct balance to show what we had used. Okay. Okay, so that's your first adjusting entry. Hooray, you did it. Yay. All right, here's another one. Oh, this is a tough one. Okay, you can take a minute and maybe give this one a try, and I'll address it in a separate video because that one might go a little long because there's going to be a new account that we need to talk about. Okay, so I'll see you in that video.